We have been looking at the topic 3. We have been looking at topic 3 in respect to assets and liabilities. Assets and liabilities. We have done a good number of items, and now it's becoming interesting as time goes by, So we have this. We have talked about assets held for sale, assets held for sale. Assets held for sale is under IFRS number 5. We have also looked at the impairment of assets. Friends, this was IS 36. Then we also looked at the exploration, and evaluation of mineral resources. This was IS, not IS. It's now under the IFRS family, or IFRS 6. Then we also have what referred to, apart from exploration and evaluation of mineral resources, we have talked about financial instruments. And on financial instrument, it was IS 32, IS 39, IFRS 7 and 9. So we have looked at that. Then we also have share-based payments. That is IFRS 2. Then we also looked at in employment benefits. Employment benefits, IS 19. We also, now this one we have not done it. This is accounting for taxes. Accounting for taxes, IS 12. Friends, you have noticed that in the previous sessions, we did this, and we also looked at this. We have also looked at this. We have looked at this one. We have looked at this. We have also looked at the most recent session. We must have looked at IS 19. Now we have not looked at the IS 12, accounting for taxes. And that's what we want to do today. So accounting for taxes. Accounting for taxes. Accounting for taxes, that is IS 12. Now, when you talk of taxes, we are simply referring to the amount out of the profits, that you should remit to the tax authorities, to the government of a country, right? So, like for example, if you say in Kenya, the tax rate is at 30%, the corporate tax rate is 30%, right? So those are the amounts out of the total profit you have made. There is a tax element that you need to remit to the government for operations, because the main source of revenue for government entities or activities is taxes. Fine. So we have accounting for taxes, IS 12. Now we are very much concerned, let me just say that tax, that is an amount of profits remitted to government authorities for operations, for financing the activities. We are concerned, accounting for taxes, we are not concerned with the amount they recognized to be remitted to the tax authorities, but we are so much concerned with how do we account for tax in the books of accounts. So when you talk of tax, we are concerned of the current, we have the current stroke the income tax. Then we also concerned with the deferred tax. We are concerned with the deferred taxes. Those are the main two items we'll be concerned. How do we account for current or income tax? How do we account for deferred taxes? That's what we're concerned with. Now, friends, one thing you also need to remember, when it comes to current tax, it's almost straightforward. So when we talk of current tax, current taxes, or we can call it corporation tax. Corporation tax or current tax is not something that should worry us so much, because it's so straightforward. The amount of taxes, how to account for this. So determine the corporation tax, the corporation tax, which is actually the current tax, the corporation tax for the year. That is, the current tax or the corporation tax. The current tax is simply, you take the tax rate, you have the tax rate, you multiply the taxable profits. I'll also remind you something that you must have done in the tax concepts in our video. In our video for taxation, you have done the tax concepts. So you know that we talk of taxable profits. When we talk of taxable profits, this is simply the accounting profits. This is the accounting profits before tax. Accounting profits before tax. You add back the disallowables, then you subtract the allowables. Remember, the disallowables are those expenses you have recognized in your financial statements for the purpose of determining the accounting profit. But for income tax department, DTA, Department of Tax Authorities, they are not allowed to be adjusted against profits. So you add back, those are profits, you add back, but those are allowables, mainly the capital allowances. So an example of disallowables is like depreciation. We have depreciation. Let me say disallowables are e.g. depreciation expense, general provisions, items like donations to non-charitable organizations, what else? And other disallowable expenses. We also have the allowables. Allowables include capital allowance. Capital allowance can also be called wear and tear allowances. So, and etc., and any other allowable expenses. So that's how we get the taxable profits. Then, after you have got the taxable profits, now you compute your current tax. After you have determined the current tax, friends, now account for it now. So, thus, after determining current tax for the year, you need to debit the profit or loss account as an expense, that is an expense. Then you credit current tax account, the current tax account. So that is the tax expense, the corporation tax for the year. With the amount paid for taxes, we debit our current tax we debit our current tax account with the amount paid, we credit our bank. We credit our bank account. That is important. Now, one thing you also need to remember, at some point you may be required to have a current tax account. To have a current tax account like this, if it's a liability, you recognize that at the beginning there is an amount which had not been paid, then the expense for the year, the amount we have taken, the expense, the amount we have taken, that we have calculated by taking the tax rate by the taxable profits. Then you amount which has been paid, bank, this is the payments. The payments, we come and now recognize that. Then we will have the balances carried down. These are the figures which will be reported in the statement of financial position. The balance carried down will be reported as a current liability, while the amount reported in the profit or loss is reported as an expense. So just a summary of how to deal with the current tax. We don't have so much problem when it comes to the current tax. Now remember, friends, we have just summarized how to deal with the current tax. The other most important item that comes in again here is about the over or under provision of tax, under provision of tax in prior years. If there is an over provision or if there is an under provision, then it means that in the previous year you recognize you estimated more tax or you estimated less tax. So if you over provided for tax in the previous year, then this year it will be reported as a credit, as an income. So an over provided tax in prior year will be recognized as an income in the current year to reduce the effects of the tax expense of the year. That's what you do. That is an over provision. The same thing with an under provision. An under provision will be considered to be an income. An under provision will be considered to be an expense. The under provision will be an expense. In the year. So it will increase our current tax expense for the current year. So those are some of the items that you may have when we are dealing with taxes. That's very important. Now we'll want to move further and look and talk about deferred tax and talk about accounting for deferred tax. Accounting for deferred tax. Still, we are under IS number 12. Don't forget that. This is IS 12. Even this one was IS 12. Don't forget, we are still under IS 12. So when you talk of deferred tax, deferred tax is the amount of tax that you enjoy in the current year, of which tax should be paid or should be received in the future period. So when we talk about deferred tax, we are taking advantages in the current times, but the tax of which will be either paid or received in future. It will end up to be a tax credit or a tax debit in future. That's the deferred tax. Now, how do we determine the deferred tax? This deferred tax may either be, we may have a deferred tax income. We're interested to have the deferred tax. There is a deferred tax income, and we may have a deferred tax expense. We also have the deferred tax asset, and we have the deferred tax liability. You need to also remember, I've said that the deferred tax income or expense is the income that we have earned in the current period, but we are likely to receive or we are likely to pay or not even in future. Then the deferred tax asset or liability, the deferred tax asset is the amount of tax that will be receivable in the future period, while the deferred tax liability is the amount of tax payable in the future period. That's important to know that. Deferred tax asset, I can remind you this, the deferred tax asset is the amount of taxes receivable in the future, while the deferred tax liability is the amount of taxes payable in the future. We'll have to define some other items later in details, but for now we have to talk about a few items here, like the deferred tax asset and deferred tax liability. How do we determine the deferred tax asset or liability? If we are to compute the deferred tax asset will take into account the tax rate you multiply by deductible temporary differences. And how do we compute the deferred tax liability? Our deferred tax liability is also equal to the tax rate. We take the tax rate, you multiply the taxable temporary differences. So we have this deferred tax asset and deferred tax liability, and that's what you should remember. Now the issue as well here is, how do we compute the temporary differences? What are these temporary differences? We are going to define them. What are these temporary differences? How do we compute temporary differences? So temporary differences, which I'm going to have as TD, will be equal to the carrying amount of assets, stock liabilities, which I'm going to have as CA, minus the tax basis of assets, stock liabilities, what I refer to TB. So TD is the temporary differences, and CA is the carrying amount, and TB is please remember, TB is not tuberculosis. For this case, TB is the tax base of an asset or liability. Very important, so that you don't confuse that. So at any point in time I'm talking about TB, you know that I'm talking about the tax base. So you come and say, this can be done this way, that if you take the carrying amount minus the tax base, that's the TB, you will get the TD. This TD will either be taxable or will either be deductible. And taxable and deductible TD, so this will give rise to deferred tax liability. These will give rise to deferred tax liability, while these will give rise to deferred tax asset. That's important.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.